Top 5 differences between Forex and stocks. In this video, I will summarize a few key differences between the Forex market and the stock market. Volume. One of the biggest differences between Forex and stocks is the sheer size of the Forex market. Forex is estimated to trade around $5 trillion a day, with most trading concentrated on a few major pairs like the euro or US dollar or Japanese yen, and other. The Forex market volume dwarfs the dollar volume of all the world's stock markets combined, which average roughly $200 billion per day. Having such a large trading volume can bring many advantages to traders. High volume means traders can typically get their orders executed more easily and closer to the prices they want. While all markets are prone to gaps, having more liquidity at each pricing point better equips traders to enter and exit the market. Liquidity. A market that trades in high volume generally has high liquidity. Liquidity leads to tighter spreads and lower transaction costs. Forex major pairs typically have extremely low spreads and transactions costs when compared to stocks, and this is one of the major advantages of trading the Forex market versus trading the stock market. 24-hour markets. Forex is an over-the-counter market, meaning that it is not transacted over a traditional exchange. Trading is facilitated through the interbank market. This means that trading can go on all around the world during different countries' business hours and trading sessions. Therefore, the Forex trader has access to trading virtually 24 hours a day, 5 days a week. Major stock indices, on the other hand, trade at different times and are affected by different variables. Minimal or no commission. Most Forex brokers charge no commission. Instead, they make their margin on the spread, which is the difference between the buy price and the sell price. When trading equities, stocks, or a futures contract, or a major index like the S&P 500, often traders must pay the spread, along with a commission to a broker. Forex spreads are quite transparent compared to costs of trading other contracts. Below, you will see the spread of the euro or US dollar highlighted inside of the executable dealing rates. The spread can be used to calculate the cost for your position size up front prior to execution. Narrow focus versus wide focus. There are 8 major currencies traders can focus on, while in the stock universe, there are thousands. With only 8 economies to focus on, and since Forex is traded in pairs, traders will look for diverging and converging trends between the currencies to match up a Forex pair to trade. 8 currencies are easier to keep an eye on than thousands of stocks. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.